The Iran conflict just sent a second shockwave through the market, and this time it's not oil, it's the bond market. Treasury yields are surging, emerging markets just lost 13% in a single month, and Micron, a company that reported blowout earnings, has somehow cratered 30% since. Meanwhile, Fed Chair Powell steps up to the podium and says, quote, "Inflation is in check, no need to hike." So who's right, Powell or the bond market screaming danger? That answer could determine whether your portfolio survives Q2. Let's break it down. Welcome back to Daily Market Breakdown. I'm glad you're here because today we are dissecting Powell's Harvard speech, the Hormuz Strait developments that sent stocks higher, and what quarter-end rebalancing means for the week ahead, so you know exactly how to position your portfolio and manage your downside heading into April. All right, let's get into the facts. First up, Fed Chair Jerome Powell spoke Monday at Harvard University and delivered a message that frankly caught some people off guard. His take, inflation outlook is in check and there is no need to hike rates because of the oil shock. Now think about that for a second. We have an active military conflict involving Iran, oil prices are volatile, and the Fed chair is essentially saying, we're good, we can absorb this. He also noted no wider crisis yet in private credit, which tells you the Fed is watching the shadow banking system closely but isn't alarmed. That's the Powell side of the story. Now flip to the bond market because, folks, it's telling a completely different story. Headlines are screaming that Trump's Iran war just triggered a second shockwave, and this one landed squarely in treasuries. Rising treasury yields are acting like a vacuum cleaner on risk assets. The FFEM Emerging Markets Fund dropped 13% in just 1 month, as rising yields drained capital out of developing economies. When U.S. Treasuries offer higher returns with perceived safety, money flows out of riskier markets like water running downhill. That's not a metaphor. That's literally the plumbing of global capital markets right now. And then there's Micron. This one is a head-scratcher on the surface. Micron reported blowout earnings on March 18th. The numbers were great, and yet since that report, the stock has sunk about 30%, with another 10% drop just yesterday. Why? Because in this environment, even great earnings can't overcome macro headwinds. Think of it like this. You can have the best engine in the world, but if you're driving into a Category 5 hurricane, you're still going backwards. The memory chip sector is facing questions about demand sustainability, and rising yields are compressing the valuations investors are willing to pay for growth names. On the brighter side, DocuSign beat Q4 expectations with an EPS of $1.01, though Piper Sandler rated it neutral, so even the winners aren't getting enthusiastic upgrades right now. Now, let's dig deeper into what all of this actually means for you as an investor. Here's the core tension. Powell is projecting calm, but the bond market is projecting stress. When these two forces diverge historically, the bond market tends to be the better predictor of what's coming. Not always, but often enough that you should pay attention. Think of it like a weather forecast. The meteorologist, that's Powell, says sunny skies ahead. But you look out the window and see dark clouds rolling in from the west. Who do you trust? You probably grab an umbrella just in case. That's the posture I'd recommend right now. The rising yield environment creates a very specific set of problems. First, it raises the cost of capital for every company that needs to borrow. Second, it makes bonds more attractive relative to stocks, which pulls money out of equities. Third, it punishes the most speculative, longest-duration assets the hardest, and that includes high-growth tech, emerging markets, and anything priced on future earnings rather than current cash flow. The Micron situation is a perfect case study. Great current earnings, but the market is saying, I don't trust the future enough to pay up for it. That's a yield-driven repricing, plain and simple. The geopolitical overlay makes this even more complicated. The Iran conflict introduces supply-side oil risk, which is inflationary, but Powell says he can look through it. The question is whether the bond market agrees. Right now, it doesn't. And when bond vigilantes disagree with the Fed, volatility tends to spike. We're also at quarter end today, March 31st, which means institutional rebalancing flows are adding noise to every asset class. Don't mistake rebalancing-driven moves for fundamental signals today. Let's check in on Tesla and Nvidia. Now, I want to be transparent. Today's data feed did not include specific price action or headlines for either TSLA or NVDA. What we do know is that the broader semiconductor space is under significant pressure, as the Micron 30% post-earnings decline tells us. NVIDIA, as the flagship AI chip name, is not immune to the yield-driven repricing hitting growth in semis. If Micron, with blowout numbers, can't hold its gains, that's a warning sign for the entire sector, NVIDIA included. For Tesla, the geopolitical environment and oil dynamics create a mixed picture. Higher oil prices theoretically benefit EV adoption long-term, but rising rates hurt the financing costs that many Tesla buyers rely on. Neither name had direct headlines in today's feed, so I won't speculate beyond what the data supports. We'll update you as soon as fresh data comes in. All right, here's my personal take. My bull-bear score today is 4 out of 10, leaning bearish but not in panic territory. Here's why. The base case. Powell is right. Inflation stays contained, the Iran situation doesn't escalate further, and yields stabilize. In that scenario, we get a choppy but ultimately sideways market through Q2. The risk scenario, the bond market is right, yields keep climbing, the Iran conflict widens, oil spikes further, and we get a genuine risk-off rotation that takes the S&P down another 5 to 8% from here. The probability I'd assign? Roughly 60% base case, 40% risk scenario. That 40% is too high to ignore. So what do? You don't panic sell, but you also don't go all in on the dip. You tighten your stop losses, you review your exposure to rate-sensitive names, you make sure you have some dry powder, cash on the sidelines, ready to deploy if we get a real washout. And if you're newer to investing and want to practice reading these kinds of setups without risking real money, check out Weeble's paper trading feature. There's a link in the description. It's a great way to build your skills in exactly this kind of volatile environment. All right, let's wrap it up. Today's bottom line: Powell says calm, the bond market says caution, and the smart move is to respect both signals. We're in a market where great earnings can still lose you 30%, where geopolitics can move treasuries more than the Fed, and where quarter-end noise can mask real trends. The key takeaway: risk management is not optional right now, it's the whole game. Stay informed, stay disciplined, and I'll catch you in the next one.